Welcome, welcome. Cost accounting and performance measurement. We're just continuing on with fun and exciting stuff. Quick review, don't forget to do your homework. Do one question at a time, check the answer. One question, check the answer. Make sure you're understanding the key concepts. If you need homework help, go to the homework helpline right online. We can help you there. Otherwise, just keep powering through the material. We're looking at cost accounting and performance measurement. Actually, a pretty exciting, interesting section. You may recall from the previous section, we talked about manufacturing costs. And we said with manufacturing costs, we've got direct materials, direct labor, and factory overhead, manufacturing overhead. Materials, labor, and overhead. Now, we said materials and labor together were called what? Prime costs. And labor and overhead were called what? Conversion costs. Good. Now, with materials, those are the materials that become an integral part of the product. What can go wrong with materials? You either pay too much per pound or you use too many pounds. Now, let's think about it logically. If you pay too much, who messed up? Purchasing or production? That would be purchasing. If you use too many pounds, who messed up? Purchasing or production? That would be production. All right, direct labor. With labor, that was the labor directly to convert a raw material to a finished good. That was the labor that became an integral part of the product. Now, what can go wrong with labor? You pay too much or you use too many hours, which is efficiency. Now, as far as paying too much, let's see. Is that personnel or production? That would be personnel. What about efficiency? You use too many hours in the factory. That would be production. Now, in looking at this, remember we've also got our overhead. What is overhead? All other factory costs except direct materials, direct labor, indirect materials, indirect labor, factory insurance, rent, utilities, electricity, air conditioning, depreciation, property tax, everything else in the factory except materials and labor. With materials and labor, or with overhead rather, what can go wrong? And here's my little trick. What is 4 plus 3? Even my videographer goes, 7, right? S-E-V, spending, efficiency, volume. Spending, efficiency, volume is 4 plus 3, S-E-V, spending, efficiency. With spending, what does it mean? Well, spending has both fixed and variable. In other words, you spent too much on fixed overhead like the rent. You spent too much on variable like electricity. Efficiency, that is all variable because it's like electricity. Volume deals with production volume, production capacity. This is fixed. So you can see that we're going to have some fixed and variable variances here in overhead. These are not too bad. These are ugly. Right? You might remember from school going, well, I don't even get this stuff. Well, hopefully at the end of the lecture, you'll go, oh, that makes a little more sense. So we got materials, labor, and overhead. The whole purpose of this first part of the section is, dude, who stole my car? Dude, what could go wrong? The purpose of this is to aid in budget process, pinpoint trouble areas, and evaluate performance. It says in your notes, in setting goals, for the efficient production of inventory, companies establish standards for the components that determine materials, labor, and overhead. At the end of the period, these standards are compared actual with variances in order to figure. So we're going to compare actual and standard allowed for actual in some case, and we're going to look at the differences or the variance to see what went wrong. And the main thing is we want to not give the finger, but point the finger. Good job, bad job, good job, bad job. So we're going to go out here and say, if this is good, hey, purchasing, good job. But here's the problem. Maybe they did a good job in purchasing and they bought cheaper materials. But maybe they were so cheap that it took us more materials to get the quantity we needed. So we've got to look not only at these, but at the total variance as well. Same thing here. We hired cheaper people, but they're lazy. They don't work as much, so it took them longer to do it. We have to look at the total variance as well. So as we go through this variance analysis, we're trying to evaluate and see what can go wrong and who's responsible. Who's responsible? Purchasing, production, purchasing, production. What could go wrong? You pay too much, you use too many hours. What could go wrong? We spend too much, we're less efficient, our production capacity is down. This one really means that the factory stood idle for a while. Like let's say we can produce 100,000 units and we only produce 90,000 units. What does that say? It says that we wasted production ability of 100,000. Our production volume variance, our production volume was down. That's a problem. All right, looking in your notes on the first page there, it says in